What is up YouTube? My name is Aditya and welcome back to our channel Varchaswa Trading. In this video, I'll be discussing about the Wyckoff accumulation and distribution on smaller time frame using the simple criteria to refine your entries and take some high probability trades. Before we proceed further guys, this is the part 2 of the video that we have uploaded previously on our same channel. So if you haven't watched that video, the link is down in the description. Please go ahead and check it out. So let's just jump onto the charts and try to understand how we can take some high probability entries using this simple concept. Alright guys, so we are on the Nifty spot chart here, and if you can see there are already some predefined levels that I use to initiate some trades. Now how do I make use of these concepts on smaller time frames? So let's say this is a level of resistance, okay, and let's say this is a level of support, and if I wish to look for a long trade, I need to understand that there should be some accumulation below and then the prices should push higher. Now it's very important for us to understand how we can use the concept here. So let's say this is the wick and this is that up candle or the up move, and this is that wick. So in the previous video we had understood that this is where the accumulation takes place and this is where the price goes up and this is where the distribution takes place. Now once we are here at a resistance level or once we are at a support level, we need to anticipate this candle. This is important. The word anticipation is very important in trading. You have to anticipate where your setups are forming. You have to anticipate how this candle would form when the prices are around this point of time. So what I do is, let's say the price goes up and it touches around this level and it falls lower. Alright, so I need to understand if there is any accumulation around this point of time. I need to understand if there is any accumulation around this point of time. Alright, so let's say the price opens around this area, okay, and this is 9:15. The price opens around this area and the price falls lower. This is my resistance point. This is the level where I have resistance. So this means that the price opened around this point. Okay, this is the opening price. This is the opening price. So once the price goes below the opening price, obviously what do we have? We have this wick on a higher time frame. Because eventually if this is a true accumulation, the prices will be pushed higher and it will move up like this. This is what we need to understand. Alright, so this is my resistance, this is my opening price, the price opened near the resistance, the price went below to create a wick on a higher time frame and then it simply pushed higher. This is what we need to understand and that's how we'll be proceeding to take our trades. The same case, if you see here, this is what we have. Let's say the price opened around this point of price, this point of level or whatever it is, and it goes up to create distribution and then it pushes down lower. So this is what? This is a wick on higher time frame and this is that body. This is what we need to understand and anticipate and then initiate trades. So if I come here guys, have a look. This is what? This is a daily time frame order block. If I go here, this is what? This is a daily time frame order block. Just have a look. This is the down candle. This is the up candle. Yeah. I'm pretty sure not many of you guys are using these candles, but that's how I use it. Alright. So if I go to 5-minute time frame, just have a look here guys. This is the this is the daily time frame order block. This is the opening price. Now I need to have an anticipation that the price went lower. This means that there is a high possibility of this being an accumulation and then the price is being pushed up. Okay, and that's where I tried to enter around this point of area. This is where I added more positions and exited right at this candle. Alright, so this is how we need to proceed guys. Anticipation is very important. You need to understand that this is the opening price. Hence, if the price goes lower, it is very likely going to form a wick on the higher time frame and then it will form a body on a higher time frame and then probably a wick. This is what we need to understand here. Now if you see this, there was a downfall as well. The opening price remains the same. Okay, the opening price remains the same. Now any accumulation above the opening price is something that I would not prefer to take trades on. I need the price to accumulate below the opening price. I need this particular script Nifty 50 to accumulate below the opening price and then pushed higher. Okay, so if there is any accumulation above the opening price, it's probably going to be a distribution and you will see a fall in price. This is how you need to anticipate the movements. Now if we come here, let's see this. This is my opening price. Okay, this is my opening price. This is where the price dipped below. Obviously there is some distribution or accumulation, whatever it could be, but it dipped below the opening price and then it pushed higher. That's where I got a confirmation that this is probably gonna be pushed higher, because anything below the opening price is okay. I guess it just touched it and then pushed higher, but fine. My bias was bullish. I had this daily order block. That's where I went long. That's how you need to anticipate, because also the accumulation was pretty small here, so we can take a chance of pushing the prices higher. That's how we need to proceed. Now let's go to a different chart here. Alright, if you see here, this is the opening price. This is the opening price. So on this particular day, if my bias is bullish, I may not get any trade. Definitely there is a wick that would look like this on a higher time frame. On a higher time frame, this wick would look like this would still look like a wick on a daily time frame, right? Now if the price simply pushed higher before going lower than this opening price, then it doesn't clearly mean to me that it's an accumulation, and on this day I would avoid trading that particular stock or script. All right, now if you see this is the opening price, and look here, the opening price. All right, that's very important here. Before falling lower, the price had to come up, hunt that particular opening price area, and then push lower. This is distribution. This is what we need to understand. If we can identify these things at the right particular point of time or the day, definitely we can identify some good moves. Now in this case, obviously this was not an accumulation nor distribution until here. This was a distribution. That was a very small distribution and the price went lower. So there are two types of entries that you can make use of. Let's say this is your opening price, and if the price is accumulating below the opening price, you can take a long. Now if the price simply, let's say it's trading above the opening price and it's hunt this particular level and then push higher, this is where you can look for your long trades. Now you need to understand this, that this alone cannot be a successful move. You need to have a bias. You need to have your technical analysis in place to take such trades. If you are unable to identify your bias, you should have a bias. Okay, and this is just to refine your entries and nothing else. All right, so if you see this is what we have. This is a distribution for me. If my bias is bearish, this is a distribution for me. If my bias is bullish, I'm probably going to be looking for a long trade, but then I need the price to spend time below here and then be pushed higher. However, if the price simply creates a wick, I need to anticipate this as a wick, and then I need to anticipate this as a body. And then when the price touches some support or whatever the position it's trading near, that is where we'll have to book our profits. Again, in this case, if you see here, this is the opening price. The price goes up. Hence, this clearly means to me that this could be a distribution. This is not an accumulation. This could be a distribution. The price goes up, reverses back down and falls lower. So this is how I need to anticipate this as a wick, and then the price falling lower as a body. In this case, the price simply went lower. Now it's important for me to understand again that if there's no trade, I'll simply avoid it. I cannot force anything using this particular criteria. Okay, so you may not be able to trade Nifty, Bank Nifty every day with such entry techniques. However, the day you get it, that's when you take it. If you see here, this is your opening price. If you anticipate this to be a wick and this to be a body, you can definitely take some good moves here. And if you see this is where the price dipped below the opening price and simply pushed higher. That's both the entry criteria are fulfilled here, and that's how we need to proceed, guys. It's very important. If you can identify these things, obviously you don't have to take trades every day. That's very important, because if you're simply taking trades every day, then you are on the verge of blowing up your account. If not today, then tomorrow or probably in a year. That's how it is. You have to be very patient with your entries. You have to have like different criterias before entering a trade. You cannot simply take trades every day. You need to know when your setup is forming up. So if you see this, if you see this, out of 10 we at least got like 5 to 6 trades. Now you have to be very attentive in taking those 5 to 6 trades. All right, your setups may not form every day, but whenever it forms, that's where the highest probability is. Now look at this. This is the opening price. The price goes higher up here. If your bias is bearish, if you see that this is a supply zone, something like this, okay, probably, yeah, this, if you feel that this is your supply zone or whatever the analysis you do, because this is a supply zone for me, and if the price creates some distribution setup around this area, this is where you can go short. Okay, so let's have a look at any more examples if we have. This is the opening price. Okay, so this is the opening price. Price dips just above the opening price and then simply falls lower. Now obviously you need to have a bearish bias to initiate this trade. Okay, so this could be an accumulation. However, the price decided to not push higher. See, most of the time if you are looking for an accumulation or distribution, it is gonna occur near the opening price. It's gonna occur near the opening price. Hence, if you can identify the prices, the behavior around this opening price and your support and resistance levels, that is when you can take some high probability trades. All right guys, so this is where I'll end the video here, guys. Thank you for watching the video till the end, guys. If you liked it, make sure to share it with as many people as you can. Hit the like button and subscribe to our channel. If you wish to reach out to us, you can message us on our Instagram profiles. The link is down in the description. Thank you so much.